Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. How many of you, in your efforts to learn about selling options like covered calls and short puts, have maybe heard somewhere along the line somebody say, you need to sell at exactly this strike every time. Maybe it's the 30 delta, maybe it's the 40 delta, maybe it's the 70 delta. But in any case, today I wanted to address something that I call the myth of the magical delta. I think this is going to be an interesting discussion. We want to talk about the pros and the cons of different strike prices when selling options. It's going to be a lot to cover. Before we get to that, though, let me first of all say hello to everybody who's already chatting in out there. Great to see so many of you. Hello there, Will and Eva, Frank, Kurt, Mike, Life in the Fast Lane, Tori, I saw a bunch of others here, Andrew, Brown Buffalo, Lawrence, everybody else. Thanks for joining us week after week. We really do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us in the live discussion. This is a Monday webcast series. It kicks off promptly at 2 Eastern time. We would love to have you here in the live stream audience if you'd like to join us. And also, as a nice little treat here for our live stream audience attendees, we have James Boyd hanging out in the chats. James is going to be addressing any questions that I can't get to just during the natural flow of the presentation. Thanks for having my back there, James. And James and I would also like to issue an invitation to everybody watching. If you have an account on the platform known as X, give us a follow there. It's the best place to connect with your favorite presenters in between the live streams. James is really active there on that platform. So yeah, if you want to connect with him and with me and with others, give us a follow. James can be found there at James Boyd CS. You can find me there at Cameron May CS. All right, but let's get into this discussion, this myth of the magic delta. Now, as we do, of course, we need to be aware of things that are not mythical. There are risks associated with investing. So this is important information. Please bear it in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks, including loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so let's set the agenda for today's discussion. First thing that we're going to do is we're going to take a look at our current example trades that are already in progress. See what we can learn from those. We have some covered calls. I think we have at least one short put. We're going to talk management of those positions. And then we're going to get to the current markets, take a look at what kind of an environment covered call traders and short put traders are dealing with. And we're going to use that to set the stage for planning and placing a new trade. But in selecting that new trade, and just so you know, we're going to be selling a put today. I think we do have 3 covered call positions, just 1 short put position. So let's build up the short put representation in that example portfolio. But as we do that, let's talk through this concept of, do we always have to sell the same strike, maybe guided by delta, which is a probability number among other functions? Or can there be pros and cons to maybe moving to a different strike? Yeah. Well, as a spoiler alert, there's not a magic delta. There's not a magic strike. There are pros and cons to each, so we're gonna learn how to balance the decision, how to weigh which strike price to choose. But let's go have a look at our example paper money portfolio. So this is on the Thinkorswim desktop trading software platform. You can download this free of charge from within your Schwab Online account. And right now we have 4 positions. We have Apple, we have IBM, we have NEE, and we have Wells Fargo. So starting here with Apple, we have 100 shares. Notice trade price exactly $235. That should be a big tip. This was an assigned short put. So let me go revisit the logic of what got us into this Apple position. So here's Apple. We actually sold a put as the stock seemed to be rising up through a resistance level. Looked like that was up around 237, possible broken price ceiling. We sold that put right here, thinking, well, it's a bullish trade. Maybe the stock is set to go higher. The stock did not go higher. It actually broke down. We sold the 235 put, collected $3. That gave us a 232 break even. And yeah, we dropped well down below that break even, actually maybe down to that next level of support. And George says, note, selling cash secured put has a similar risk profile as a covered call. Exactly right, George. So maybe I'm going to pause this revisiting of a previous, what got us to our Apple position today, to give some extra attention to what George has just pointed out there. I actually spent an entire webcast doing a side-by-side comparison of covered calls and short puts just, I think, a couple of weeks ago. Let's go to the Trader Talks channel on YouTube. So if you haven't subscribed to Trader Talks, by the way, do that right now. Go down, you can click on the subscribe button just below the video stream if you haven't done that already. That'll subscribe to our channel, but our channel is where we house all of our previous webcasts. So you'll want to find on YouTube Trader Talks Schwab Coaching Webcasts, and right here on the home page, we can find the playlist of previous webcasts, and of course you can join the live streams here as well. But I'm going to go to the playlists, and let's scroll down until we find trading covered calls and short puts. It's going to be a little ways down. Might even have to scroll twice. Let your scroll bar catch up. It's right there toward the center. And as we view that full playlist here, you'll see right here, covered calls versus short puts. Which strategy is quote unquote better? And as a spoiler alert over here, are they secret twin strategies? Yeah. They have lots of heavy similarities in the risk and reward profiles of those strategies. So yeah, good point there, George. But let's go back to our current position where we just have long shares of Apple. Well, when we fell below our 235 strike, someone has the right to sell shares for us for 235. And as we cross that expiration threshold for March 21st, you can see we're still down here below 235. So we were assigned for $235. The stock is trading right now at $219. So we're underwater on the stock. We have a little bit of a consolation prize in the fact that we collected $3 from this premium, which is now a realized gain on that short put. But yeah, we've got some digging to do to get out of this trade. But what a trader might do now that we own the shares, before we do anything else, the trader might want to decide, well, do we actually still want to own the shares? I mean, we could just sell the shares. Take the loss. Unfortunately, there's nothing that we can do at this moment to reverse where history has delivered us to up to this point. The market's got us here. Only the markets can get us out of here. So the trader might ask themselves, well, if we retain ownership of the shares better go up in price. Selling a call, which is what I'm actually going to do, selling a call can bring in a little additional premium, but still, we need the shares to go up to get back up to the value that we paid for those. If they fall, we might see losses continue to stack up. So let's just say that our trader here has decided, you know what, I still feel that Apple is going to bounce head higher. It's not a bad start, right? We were assigned and we're climbing a little bit. That's helped a little bit. We'll see if we can keep going up here, get up to maybe our break even. Maybe we can lower that break even level. We won't have to get up quite so high if we sell another call. So let's do that. Now, James is saying, no way, just close the trade, take the loss, move on. Is that a choice? It absolutely is. Yep. Could we also choose to retain ownership and sell a call? Yep, we could do that as well. I'm going to do that. Let's keep this wheel turning. We talked about the wheel strategy in the last couple of weeks. Let's go see how much we get for this. Since we were assigned the shares at 235, if we sell a strike below 235, we'd be contractually agreeing to sell the shares for less than we paid for them. So how about we go look at maybe the 235 strike. Let's go out here to the 17th of April. Still 24 days left on those contracts. 235 calls are selling, all right, for 87 cents to 89 cents. There's some premium there. Some traders might look at that and say, that's not a lot of money. Well, could we consider selling and getting into a contract to sell the shares for less than we paid for those? Like, let's say we did 232 and a half. That might bring in a little bit higher premium. There's a pro to doing that. The con is, yep, now we might have to sell the shares for less than we paid for them. Does that mean we lose money overall? Not necessarily. Because our break-even point, we already have $3 of realized gain on that put that we sold. So our break even is actually at 232. So this would still be an above break even trade if we got called. Okay. So we'd be selling the stock at a small loss, at a $2.50 loss, but that's after already collecting $3 on a put. And that would be after collecting maybe another $1.25 here. It'd still be a net profitable trade. So which one might the trader want to do if they're deciding to go for retention of share ownership? It's up to that trader. I think for this one, let's just collect that smaller premium, give that stock some more wiggle room to maybe get all the way up back to where we bought that. Not as much premium there, but we're going to do that. Let's click on the bid price. We only have 100 shares, so we just want to make sure that we're selling one contract of those 235 calls. And let's see if we can get, let's say that we're willing to settle for 85 cents. I'm only doing that I'm trying to increase the likelihood of a relatively quick fill here while everybody's watching and we don't have to wait for this to fill. Maybe if I had the luxury of nursing this along for a few minutes, we might go for a little bit higher credit, but let's put in a credit requirement at a limit of 85 cents. I'm going to click confirm and send. We're going to sell to try to get another $85 here. Notice it's going to say max loss is infinite. That would be the case if this were a naked call position. This is a covered call position. We're doing this in the same account where we hold the shares already. But we're selling that 17th of April 235 call for trying to get 85 cents. There is a commission to be paid, so that would cut our $85 credit down to $84.35 if we get it filled at that price. Let's see if we send that off. All right, we filled that for 88 cents. Okay, so that position we've had a look at, we reviewed. Here's another one, very similar. Didn't get here exactly the same way. With IBM, this one actually began life, it started life as a covered call. We bought the shares at 249.05, sold a call up here at 265 on the same date, and you'll notice we actually rallied up, so the shares were doing well, but then they've kind of come back and kind of waffled around. So we were below our below our strike price at expiration. That contract has now expired. We've now realized the gain on that, which was, I believe, $2.03, I think was how much we collected for that. That gave us a break even of 247.02, which is interesting. Look where we're trading right now, 247.15. So we're right at a break-even point. We could just say, you know what, let's just be done. No harm, no foul. Maybe a commission to be paid, getting in and out, well, getting into, not out of, this short call. But, or the trader, if they decide to hold on to the shares, could consider maybe selling another call. I think that's what we'll do here today. Let's sell another call. We're still just right at the break-even point for this trade overall. But I'll bet we might have to come down to 250, maybe to 255. Should we look at 255 first? Well, it looks like we could sell a 255 call, again for the 17th of April, about $3. All right, that's a little bit more than 1%. If someone is trading according to, let's say, a 1% rule as a minimum, that's meeting that as a requirement. Not everybody does that. But I'm going to go ahead and click on the bid price here. Let's sell that 255 call. Let's see if we can get, all right, 297. I'm going to back off to 295. That would still be north of 1%. Let's click confirm and send. Looking to sell that 17th of April 255 call for $2.95. Again, not an infinite maximum loss here because this is a covered call position. The commission, though, is still a consideration. So we're looking to collect at least $294 from this. And let's send that off. And we filled right at $3. Okay. So we're now in covered call positions here. Those calls are still holding out down here in the unallocated. Notice here's our covered calls group. Let's right click on this and move that to the covered calls and short puts group. And for our Apple trade, let's do the same thing. Let's right click, Let's move to group. There it is. There we are. That'll just look a little bit tighter. It was still a covered call position. They're still both in the margin account here. They were just in different groups, so it doesn't mean anything as far as, the risk or reward or anything like that is concerned. Okay, we actually have 4 more positions I wanted to go through. We have 2 that are still current positions. We have 2 that were closed out over the course of the week because we hit expiration after our last discussion. Yeah, we hit expiration on Friday. So with NEE, we have a short put, sold the 72.5 put. It's a bullish trade. We prefer for the stock to be above $72.5. We're actually down at 70.32. So let's have a look at that on a chart. You can see right here, sold this put as it looked like we were breaking out of resistance. We've pulled back down through that previous resistance. Still have rising floors here. We'll see if this can continue to rise. That could right the ship, so to speak. Let me right click here and extend this to the right. In any case, but we are a little bit below our break-even point on this trade. So we'll let this continue to work, but just know that this put is now in the money, and that does it elevates the risk of early assignment. Early assignment is still less likely than the contract is moving forward toward expiration without being assigned. Still could happen. Even an out-of-the-money contract can be assigned. But I'm going to let that one work. There, just so you know, there is no risk of early assignment in paper money. It doesn't happen. Nobody's out there exercising fake trades. But in real life, there is that risk that we have to bear in mind. So with NEE, we're going to leave that alone. And with Wells Fargo, we bought some shares, sold the 72.5 call. We'd like for the stock to go up, preferably if we didn't want to get called out for the stock to stay below 72.5. Well, it's risen above 72.5. So actually, we're in maximum gain territory right now for this Wells Fargo position. There's our 72.5. We have ourselves in the shoes of a trader who bought the shares at 70 bucks. We had previously already sold an $80 call against that stock position, but as the price fell back, that contract we closed out for $1.65 profit and sold a new one for $1.45. So between the two, we've collected $3.10 in premium, which lowers the break even on our trade overall down here to 66.90. So you can see where the stock is right now. This trade overall actually doing just fine. So I'm going to leave this one alone, but there were a couple of others. 2 others. We had last week AbbVie, and we also had XOM. What in the world happened to those 2? Because they're not in our portfolio any longer. So here's what happened. This one's a little bit of March Madness. Yeah, we originally bought some shares at 190.71, and we sold a call up here at 210. And that stock we actually waited. We owned the shares at 190.71, watched the shares rise, and as it looked like we might be running into resistance here, that's when we sold that call right here. Collected $2.24. Now the stock went up above that 210 strike, and then as we moved to expiration, knowing in paper money, no risk of early assignment, at what level are options automatically assigned at expiration? Well, all in-the-money contracts are assigned at expiration unless there are explicit instructions left by the owner of the contract to do not exercise. Well, look where we closed. We sold the 210 call. Where did we close trading on Friday? Can't make this stuff up. $210.01. I call that a little bit of March Madness. That was 1 penny in the money. It was assigned. Shares were sold for $210. Now, we bought those for $190.71. So that was a $19.29 realized gain on getting called out on that stock, on the stock, plus $2.24 that was collected in the premium. So overall, just about a $22 profit. So that's a nice trade. Great. Now, last one, XOM. Bought the shares here at 106.92. Shares shot up to just below a previous resistance, and we sold a 115 call above that resistance. The stock was pretty cooperative, staying below that 112-ish resistance for a while. But just a week before expiration, we broke through resistance. We went up above our strike and held there, closing there 3 days in a row, including Friday. We closed at 115.50. Those contracts were assigned, or that contract. Sold the shares for 115, bought them for 106.92 for, so what, about an $8 profit on the stock, plus the premium that was collected on the option. Perfectly good trade. So we're done with that, and that is it for our existing positions. So that brings us up to speed. That leaves us with 3 covered calls and a short put. We'll see if the markets are going to cooperate that. Those are bullish trades. What have the markets been doing? Let's go have a look at the S&P 500. The S&P pulled back from these February 19th all-time highs, all the way down 10.5%, right down to, could this possibly be a nice trend line setting in here? I think for some technical traders, they may have looked at just exactly that. We pulled back down to a trend line and appear to be bouncing higher. Now, is that a guarantee that for our existing positions and anything that we put on from here forward, that's going to do well? No, it's not a guarantee. But as of right now, it looks like the S&P is starting to get ahead of steam here. It's starting to look less likely that there's going to be an all-out tariff war. Time will tell how that plays out. But let's say our traders still bullish, and maybe they're still looking out here to April 18th to put on some new trades. So let's do it. Now, James is saying bullish trades before April 2nd. Well, James, it's always up to the individual trader, right? Now, I would put on potentially bearish trades, but that's not what this webcast is about. We do covered calls, short puts. Those are bullish strategies. But yeah, we certainly have other webcasts that cover the other side of the trading spectrum, including some that I teach myself. Yeah. So I talk about, like, in long verticals and diagonals, those can be done bullishly or bearishly. But putting ourselves back in the shoes of our hypothetical covered call or short put trader, let's say they're still bullish. They still think things are likely to rise from here, and they could. The last time we pulled back 10% or in that range, the last couple of times, we've had a very sharp recovery from those lows in pretty short order. So let's say that our trader has that outlook. Let's say they're not only bullish, but very bullish. And so they're weighing, well, I could do a covered call, could do a short put. If the markets go up, either one of those strategies could work. Today, we're going to do a short put. Let me bring up a stock. I have a couple of them that I was considering. I try to spread it out across a range of sectors, across a range of stocks. Let's say that our trader was looking at Tesla. Ooh, Tesla. This is a company, and maybe I'll get your input on this because I have a couple that have pretty different technical scenarios here. But Tesla is the first one. It hit a peak all the way back December of last year and then sold off pretty hard. So what was the high here? 488, almost a $500 stock. That has been sliced by more than half. From 488 down to a low a few months later of 220. Now, since then, though, the stock started to consolidate. The highs were still coming down a bit, but the lows started to rise. What do we call this? What do we call this when we have lower highs but higher lows? For some, they look at that, and that's called a symmetrical triangle. It's a recognized price pattern. It's not, in my view, a textbook symmetrical triangle because it's typically seen as a continuation pattern, but if we get a break in the opposite direction of the trend, it can also potentially serve as a reversal pattern, and that's where it looks like at this point. So we got a strong break out of that apparent symmetrical triangle, and so maybe our trader could start to structure a bullish trade around this. Well, let me just throw out Visa as well, and then maybe what I'll do, I'll let everybody chat in. Wait until you've seen Visa, and then I want you to chat in which symbol you think we ought to do our example trade on. So let's look at Visa. Here's Visa. This is maybe more of a traditional upward trending stock. Yes, it recently pulled back, but more touch points for a potential rising trend line. That might, for some, make them feel a little bit more comfortable that we have a stronger price floor here. And very recently, we've run up off of that trend line, pulled back a bit. What might we call that little behavior right here? The run up, the pullback, and then a continuation. Yeah, to some, they might call this a bull flag, in keeping with the previously established trend. So we'll see if this works out. But now that you've seen both of those, should we structure our new bullish trade on Tesla coming back from that strong sell-off? Maybe traders see, oh, now it has more upside. Or maybe should we go for Visa? What do you think? Chat in TSLA or Visa. What's your vote? And as you chat those in, I'll let you know we are going to be doing a short put again. And I really want to talk about why when we hear, oh, we should always sell, let's say, a prescribed delta. And I'm just going to use 30 as an example because, well, I hear that quite a bit. Okay, I'm seeing Tesla gets one vote, but then Visa, 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 Visa. Okay, so let's do Visa. All right. So here's Visa just breaking out of this bull flag. Looks like that's right at the 340 level. I wonder how much premium would there be even if we brought this all the way down to this trend line? That would be the 330 strike. That would be all the way down here. So if we set up a trade where if we can just be above that 330 at expiration, let me go see what the premium looks like there. Let's go to the 17th of April. We're going to go to the 330 puts. And okay, those are trading $2.50 to $2.55. We can call it $2.50. Is that a full 1%? No. But in the spirit of weighing the pros and cons of the choices that we have here, does it always have to be 1%? No. Some traders don't require 1%. They might be perfectly happy saying, hey, I might be able to make $250 on this trade. As long as the stock is above 330 at expiration, I should be in good position to make that $250. So let's keep that in consideration. Now, I'm going to hit the pause button right there because we have an opportunity here. I just noticed, thanks for pointing it out, Eva, there is a survey in the chat window that's just been added, and we don't get surveys in every webcast. So when you have the opportunity, if you take that opportunity, that'd be fabulous. But do this as a favor for me, if you would. Click on that survey link, have that up and ready so you can fill it out after the webcast is over and you can give me some honest feedback, because I'll tell you a couple of things about the survey. Number one is that they're really short. 2 multiple choice questions and a comments box and a suggestion box if you want to take a little extra time to fill that out. But to whatever extent you complete that survey, I promise you, it's not a wasted effort. I will take the time to read through that data. I read through the comments, and it definitely helps. So thanks for doing that. But back to our trade scenario here. So we have a technical choice. We could sell the 330 strike, as that's the one maybe closest to our trend line right now. But other traders would say, Cameron, no, a trader should always sell a 30 delta. Be careful with that phrase always when it comes to trading or investing, because it implies there's something magical about whatever that thing is we're about to do. And there's nothing magical about any particular delta. But let's go. R. William says, what about a short put and a protective put diagonal? Well, William, that's a consideration, but we don't do diagonals in this webcast series. It's called covered calls and short puts. So good observation. That might be a discussion for maybe my Thursday webcast series, which is called long verticals and diagonals. But in any case, let's go back to our trade tab. And once again, let me know. Have you ever heard somebody say, oh yeah, well, the seller should always sell a 30 put. That's the magical delta. That's the right combination of probability and reward. The Black-Scholes formula is far too sophisticated for that, okay? Well, let's talk about what that delta means, because if we were to follow the 30 delta rule here, that would be telling us to sell the 335 put. That's just basically, we'd be accepting somewhere in the $355 to $370 range. Let's call it 360 bucks. Someone is paying us 360-ish dollars for the right to sell 100 shares of Visa to us for $335. Well, the delta here is a probability number. Now, there's another thing that delta does for us. It can tell us how much we might make or lose if the stock goes up or down a dollar. But delta can also be a pretty good estimate of the probability of a contract expiring in the money. Now, our put seller here is actually looking for that contract to expire out of the money. So for those who choose, let's say a 30 delta, what they're telling me when somebody says, hey, Cameron, I always sell a 30 delta, I'm not saying there's anything wrong with that. As a matter of fact, it's a perfectly common practice to have a preferred delta from one trade to the next. Now, to take that preference and try to impose it on everybody else in every possible conceivable scenario, that's where we might be overstepping the lines. It can make perfect sense to have one's own preferred delta. So if somebody says, Cameron, my preference is to always sell a 30 delta, well, what they're telling me is they prefer the higher probability trades. Because this trade, if we sell a 30 delta, that means the contract has mathematically a 30% chance of expiring in the money or a 70% chance of expiring out of the money, which is a high probability scenario. But there are other traders who may not abide by such a rule. For example, another trader might just say, well, I just look at the chart and I do what the chart tells me. Maybe the chart says to that trader, support appears to be at 330. Selling a 335, 30 delta option would be up here. That would be above support. It's taking, in their eyes, a greater risk. Is there a greater reward potential for that risk? Yeah. Yep, there is. Yeah, if we sell the 335 put, we're collecting a larger premium. When we go for a higher delta, there is a higher reward for taking a larger percentage risk. The risk here is defined as 30% versus 22% on our 330 delta. So that's one example of why somebody might choose a different delta altogether. Now, there are still others, though. Let's put ourselves in the shoes of a trader who is actually maybe inherently they're just more aggressive. Maybe they're just more confident in their chart analysis, and they're saying, Cameron, you guys are suckers for considering selling these out-of-the-money puts with their paltry little premiums because I, speaking from the vantage point of a more aggressive trader, I really think this stock is about to go up. I'm quite confident in that. And therefore, I'm willing to take an even larger risk. Could they even, let's go to our trade tab again. What if somebody sold, let's see, we're at 343. What if we look at the 345 put? Bigger premium offered right there. That bigger premium should be sending up signal flares. Big premium, big reward means a big risk. If we sell a 345 put, someone is agreeing, hey, I'm willing to agree that someone else can sell me shares at 345 bucks because I don't think they're going to do it. If the stock goes up, keeps going higher, and it goes above 345 and remains above 345 as we get toward that expiration, this contract may expire out of the money. It doesn't have as strong a probability of doing that. There's a 51% chance it's actually going to expire in the money. But let's say our confident trader here might say, why would I settle for a $2.50 premium when I could collect 2.5 times that amount up here at 345 if I think the stock is going to go higher? Let's add that to our equation here. Let's draw in a line right there. That's 345. So in this scenario, this stock that's been uptrending for months, that's just broken out of the flag, all it would need to do is go yoink up a little bit higher, and that puts this trader into their maximum theoretical gain territory with an outlook to make 2.5 times the amount as this trader. So we we've looked at 3 different examples, and we could look at a whole bunch of others. Which one is the right strike price? Where is the magic delta in this equation? There isn't a magic delta. Each delta has its own advantages and its own risks. And so a trader just needs to understand what those are and then just make the decision for themselves. And I think what I will do in this case, how about let's go for the highest probability trade. I'm going to go down here to that 330 strike. Let's go over here to our trade tab. Let's go to that 330, still in the neighborhood of $2.50, $250 for doing this trade. If it works out, it still carries with it an obligation. We might have to buy the shares. If we do, we don't have to pay nearly as much as maybe this person. We're agreeing to buy the shares for 330, not agreeing to buy the shares for 345. So a lower obligation, it also lowers the break-even point of this trade. So I'm going to do this. Let's click on the bid price. We're going to sell one contract of those 17th of April 330 strikes, and let's try to get at least $2.45 for this. That's going to be our limit. Let's click confirm and send. And let's sell just one of the 17th of April 330 puts, 245 limit. That would give us a maximum profit on the short put position of 245. If the stock crashed on down to 0, we could lose up to 32,750. It's always a little bit intimidating to see those big numbers, but it's also helpful to put it into proper context. What is the likelihood that Visa is going to go to 0 value in the next 24 days? It could. It's just highly unlikely to. So as intimidating as this can be, there's real context there for that. But in any case, there is a commission to be paid, which will chip away at our credit if we receive it a little bit. Let's send this order off. And okay, we filled at 257. Let's chart that. Let's go back to our charts. So let's get rid of this one. Let's just remove a bunch of these drawings. We didn't do any of these ones, so we're just going to take them off. We don't really, should we leave the bull flag on there? Might as well, that's fine. But right here, I'm going to change this line to red to indicate that we just sold this put. Let's put a text note on there. What do we sell that for? 253? Was that what it was? Let's see, there's our Visa. Let's move it up. Right click. Let's move that to our covered calls and short puts group. And we sold that for 257. Okay. So I'm going to put a text note right here. Sold the 17th of April 330 put for 257. There we go. Edit the properties there. Little right-click functionality. And so that would put our break even down just below that. It'd be down around 327.5-ish, 327.47. All right, so Mark, you like that? The comparisons? Yeah, I think we just need to know how to weigh the pros and the cons of the different choices there. And so I like to do those side-by-side comparisons because these myths creep into trading. And I think that it's attractive to someone who's trying to learn this stuff because we all want to know what's the magic delta. Just tell me which strike price is the one that I should always choose, and I'll just do that if I'm going to pursue this strategy. There is no magic strike price, and it's a disservice to the trader to teach otherwise. Now, we need to be able to recognize there are real advantages to different strike prices, and there are real disadvantages to different strike prices. So there we are. We're in that trade. We'll see how that goes from here. We've caught up with our previous trade, so time for me to let you go, everybody. This is what we do with our Mondays. We learn about bullish strategies like selling puts and covered calls. In this case, we just like the stock to go up so that we can keep this premium, that 257, as long as the stock is above 330. It's unlikely, still possible, but unlikely that the contract would be assigned. And we're just trying to get to that April 18th expiration. So that's the outlook for this trade. But we've managed existing positions. We took a look at the markets, and we placed a new trade while talking through this myth of the magic delta. So yeah, Ricebird says there's no magic. Eva says, sorry, there is no magic delta. That's not to discourage anybody from having their own preferred delta, but just choose it to line up with the trader's personality and the trader's preferred approach to the management of their portfolio. All right, everybody, go enjoy the rest of your day. I will see you in a future webcast, but as a reminder, you have other resources available to you. So first of all, make sure that you're subscribed to our Trader Talks channel on YouTube. You can just go down, click on the subscribe button just down below the video stream. Our channel on YouTube, full name is Trader Talks Schwab Coaching Webcast, and make sure you find the right channel. But you can find our playlist right here, and you can join the live streams right there. Now, James and I also want to issue an invitation to you. Make sure that you are following us on X if you have an account on that platform. Follow your favorite presenters, because that's the best place to connect with us in between the live streams. So you can find James on X at James Boyd CS. You can find me here at Cameron May CS. When you're dealing with social media, always make sure you're very precise with usernames that you are following, because there are lots of similar usernames out there, some of which have sort of nefarious intent. So, yeah, mine is at Cameron May CS. But everybody, I will see you in a future webcast. I do appreciate everybody that's already clicked the like button. It looks like 56 have already clicked the thumbs up. Thank you for doing that. I always appreciate it. Always sounds like applause to me when somebody gives a thumbs up. It also gives a boost in the YouTube algorithm for my webcast. Helps it find a wider audience. So that's fantastic. But thank you. If you've already filled out the survey, great. Now's your opportunity. If you haven't done it, go click on that link that James has reposted, and you can fill that survey out now. But I'll see you next week. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish the very best of luck. Happy trading. Bye-bye.